or so before we start, just because there's still people who haven't joined. And then while we wait, I also just wanted to tell you guys to remember that if you haven't, for whatever reason, if you qualify for a stimulus check and you haven't received it, I think this week on Wednesday is the last day to register on the IRS's website, that Get My Payment site, to put your direct deposit information. Otherwise, you have to wait for a paper check, and that could take ages, right up to, for some people, right up to September, depending on how the IRS is going. So again, if you do qualify for stimulus money and you have not yet received it, and it's likely because the IRS doesn't have your direct deposit information, just go to Get My Payment on the IRS website and input your direct deposit information so that you can see the money sooner. After Wednesday, you won't be able to do it anymore.
Or if you have an accountant, just pay them $100-something and then they'll take care of everything else.
Let's hope so. I mean,
now, usually you just put in all the numbers and you put all the information you provide them and give them your rounding.
But it's so easy. I mean, you do, like, I just did it because we always owe because of the marriage penalty, because separately my husband and I pay enough tax on our payroll and stuff, but when we combine our income, there's always an issue with us jumping a bracket, so we always owe. And because we owe, the IRS doesn't have a direct deposit information on file because we're always paying, not receiving. And when I went in, I have to tell you, it probably took me about 5 minutes tops to do it. So I mean, definitely, if you feel more comfortable paying someone, go for it. But it's not hard. You're putting in your name, your address, your social, your AGI from last year, your routing number, your account number, and the bank, I think, that you are banking with, and that's about it.
I also heard there was also a program that they use. Some accountants, they use a program. They just punch in some certain numbers in certain places. That's it. Everything else gets done for them. Submits everything right away.
Sounds pretty useful. That's good.
Yeah, only if you know how to use that program.
Well, that's what they charge us for then.
Yep.
For that knowledge. All right. Let me start sharing. We'll give it 1 more minute. Let me start sharing my screen here. All right. Once again, good morning. If you joined recently and I haven't greeted you, I hope you guys had hopefully a somewhat restful weekend. And for those who celebrated Mother's Day, I hope you had a good day yesterday. I just wanted to start off by reminding all of us again that the Chapter 15 homework is due this Wednesday, May the 13th. Remember, I do have office hours today, at 1 p.m. and also tomorrow at 1 p.m. to still provide you some additional assistance if needed. Otherwise, you could also just send me screenshots of things that you're struggling with so that those can maybe be resolved over email. Those who email me know that for the most part, unless something really slips through, I get back to you fairly quickly. But please don't leave it until 10 o'clock on Wednesday night, because it may not be possible for me to respond in a timely manner. Also, if you are having extreme issues with getting through any of the work, or there's something going on in your household or in your life that is precluding you from doing the work in a timely manner, please don't hesitate to contact me to tell me what's going on. I can extend deadlines for people if need be, and this should be because there's an actual, issue, concern. You've got a lot of things happening, as opposed to, just procrastination. But I do want to just state that, because I know we're in very strange times, and that some of you may have unspoken situations, at home, and you feel like maybe you can't ask for help. You can. And also, I can only extend deadlines up to a point, because otherwise I start pushing you into, being having very little time to prepare for the final. So if you do need an extension, speak sooner rather than later, so that I can help you. Remember, all the homework counts 3% of your grade. On homework you have unlimited attempts. And I'm hoping that everybody can get as high a grade as possible. And then this is still far away, but just so you remember, chapter 17 homework due Memorial Day. Again, you don't have to be sitting on that day to do it. It's just I just gave that day extra day, so maybe if people are off from work and stuff, they actually have some more time to do it. And then the next test and quiz will open on the 24th, which is in about 2 weeks, and will close on the 31st. And it's the same setup. You have the same amount of time and all of that. Nothing's changed with our dates for the final exam and so on. Remember, the last day to withdraw from any course is June the 4th, with a W grade. And also, as I mentioned before, you can go right through to the end with a class, even if you're feeling a bit iffy, because we also have this option now of credit or no credit, where you can apply. I just want to show you again. I know this might be repetitive for those who remember that I said this, but I have to keep saying these things, because I'm not sure what kind of communication is reaching you from the college, or if you guys are even able to keep up with the emails. And I don't want people to lose out on opportunities where they can still, I guess, perform or have their GPA protected, whatever, in a way that makes sense. So if you, so the 4th is the last day to withdraw. The 4th is also the last day of classes. Our last class together would be on Wednesday, the 3rd of June. That Friday is the reading day. There shouldn't be any classes happening that day. And then from the following week, from the Saturday, if you have Saturday classes, it's supposed to be the final exam, right? All your classes are conducting exams however they conduct them. Some of you may even finish earlier than this for whatever reason. Maybe you just have an essay to hand in, and you'll be able to see your grades, I guess, as soon as the professor submits them from around the 6th. If you had your exams earlier, you should see it, and that's when the first day to file for credit or no credit starts. If you want to do this, it just means that if you fail a class, God forbid, then you can actually opt for the no credit option, which means for the purposes of your transcript here, you're not going to have an F. It's just going to say no credit. It's not going to impact your GPA. And then when it comes to transfer, these things only hold within CUNY. So, if you plan to transfer outside of CUNY, this credit, no credit option doesn't necessarily have to be honored by the other school. And then credit is for when you're getting grades A through, I guess, D minus are still all passing grades. If you get a grade that you're not that pleased with, or you feel like it's going to impact your GPA too negatively, then you can change the class to credit, which means that you would have fulfilled the requirements to get the credits, but the class grade will not be calculated into your GPA. And the last day to file for this is July the 16th. Again, you'll probably have a better idea when you get closer to the time of how you're doing. But I guess what they're trying to do, and who knows how helpful it is, but what they're trying to do is to encourage people, I guess, to keep trying to go in the classes, even if it may feel like it's not going to be as successful as you would have hoped. Does anybody have questions about this credit, no credit thing, or about dates, like exam dates and things like that?
No.
You guys are good? Okay. Well, All right. So, like I said, I know I keep repeating this, but it's just so that you can have it in the forefront of your mind as we round the corner to the end of the semester. We don't have many more sessions together. I think after today we have about 7 to go. So it's things are winding down. And for classes that you see only once a week, you probably only have 3 or 4 more meetings with your professor. So you want to figure out how you're doing and so on. Um, for today, we'll continue where we left off with, at the start of the last class. I kind of started on chapter 17. I did revise the chapter notes, not for anything major. It was just that on the first question, I always keep forgetting to take it out. On this first question in the examples, the answers were already written in, so I just took them out. If you downloaded the stuff before, printed it out, it's fine. You don't have to download it again. But for those who maybe hadn't downloaded it last week Wednesday, I just put it back up with that small change. Um, so, just going back to what we were talking about last week, chapter 17, statement of cash flows, right? And I had said to you guys that this this chapter is pretty heavy stuff because it is a financial statement, but it's a financial statement that really requires you to know how the rest of the statements work, because the cash flow is kind of a separate exercise. So even when you read the opener in the chapter, you can see that they say the same thing that I was saying last week, that the balance sheet, the income statement, and what they're calling the retained earnings statement, that is often just called the stockholders' equity statement or something of that nature, don't always show everything that's happening with the company. And we said this is because of the fact that companies may have more or less cash on hand than their level of profitability. And the easiest way to think about this is if you had to start a business and you sold a product to people, but you sold it all to them on credit or on account, right? And they have 30 days to pay. Even if you make a ton of sales in that first month, you might look very profitable, but you haven't actually collected any cash. So, if your bills and stuff come due, then someone looking at your income statement would be like, oh, you made all these sales, so it must mean that you have a ton of money in the bank. And the reality is that you don't, because people haven't paid you yet. And I said the same thing applies for when you work. If you get paid bi-weekly, you get paid every 2 weeks. After the first week of work, you have earned a week's worth of pay, but you have not yet received it. So in your mind, that there's X amount of dollars coming to you, but it hasn't been collected. So because of that, and because investors do want to know um, why and how come, well, not why, but I mean what companies are doing with their cash, because if there's a cash problem, then it means that the company won't last for very long. Because of that, we have to create a statement of cash flows, because the income statement and the balance sheet don't give us enough information. Yes, the balance sheet shows the cash balance, but it only shows a balance. It doesn't show what we would call the sources of cash, so what caused cash to come in, and the uses of cash, what caused cash to go out. So when we look at why create a statement of cash flows, right? It tells us the cash receipts and payments for a period of time. It also tells us the company's ability to generate future cash flows. One of the, I guess, what do you want to call it, like indicators of a big problem is when you look at a company and you see that they are not generating a lot of cash flows over a period of time. That is a very big indicator that they may end up going bankrupt. And so for some of the companies that have declared bankruptcy over time, whether you talk about a Sears or a Toys R Us or some of those, even recently J. Crew, you would likely have, if you studied the statement of cash flows over a number of years, you start to see how the cash is dwindling, right? How they have less and less cash to play around with. And even though they may still be profitable in some ways, it just doesn't matter. You guys know this. Like if your bills are due at the end of the month and you have no cash in the bank, it doesn't matter if you go to, Con Edison and say, well, I have all these people that owe me money. I'm just waiting for them to pay me, and then I'll pay you. They don't care about that. They just want their money. And similarly, in a business situation, also, someone looking at a cash flow will be able to see whether a business has enough cash to pay their debts, and if dividends are a possibility. They'll also be able to look and see, hey, why is it that your net income is $100, but your cash is only $10? Things like that. What's the difference between accrual and cash accounting? And that also tells you something about how companies strategically handle cash collections and things of that nature. And then it also will tell you for investing and financing, what types of investments the company is making to sustain or expand the business. And also financing sounds like what it is, right? Is the company issuing stock? Is the company borrowing money? How are they getting cash to fund their operations? So again, those are some of the reasons why we would want a statement of cash flows. Any questions up to there before we go into classification? All right. Let me see if anything's happening on the chat window. All right. So, when, and you may have, hopefully you remember that I said, please read this chapter, whether it be the notes or even the chapter itself. But when you look at, and you can see it over here in the book, when we look at a statement of cash flows, we will see that it's divided up into three parts. And this is very important because when we learn to build the cash flow, we will also be following those three sections, and they are listed in order. This is the order that they go in when we make the cash flow. You can't move stuff around. It's a very systematic approach that you take to building a cash flow, especially in the operating activities section, right? So you have the overall statement of cash flows, and then within that statement, you have these three operating, investing, and financing activities. And then at the end of the cash flow, it may be possible from time to time that a company has non-cash activities that could cause what looks like a change in balances, but is actually just movements between accounts. So I'll give you an example. If you remember, maybe vaguely from chapter 13, when a company issues a stock for land, so you debit the land and you credit the common stock, and paid in capital in excess of par, but at no point did cash change hands. So when you look at the balance sheet, it looks like the company has more stock, which is true, and that might make someone think that it's because they received cash, but it's actually that they received land, which is a non-cash item. So when we build a statement of cash flows, if there are any non-cash activities, we also have to show those items so that someone trying to, I guess, rework or redo the cash flow to see if it makes sense will be able to understand why that item has not been included in financing activities. So just to go back here, let's just talk about the nature of some of these activities, and then there's a handy little chart in the textbook that I'll show you that also takes you through it a little bit. So operating activities, operating sounds like what it is. It's the day-to-day operations of the company. So this is where we we'll look at cash flows related to all the things that the company would normally do. So, what cash did they receive from customers? What did they pay out to suppliers? Were there were there any non-cash, even operating items that you have to deal with. So you can see here includes the cash effects of transactions that creates revenue and expenses, so the items which impact net income or net loss. So to make this section a little bit easier, instead of trying to begin from scratch to see how much cash was collected from customers or how much was paid to suppliers, we actually start with the income statement, which already has all the revenue and expenses in it, and then we make adjustments to net income from the income statement to get to net cash from operating activities. So that sounds, I'm sure, possibly foreign and also very confusing, but don't worry, later on when I go step by step with you on how to build a cash flow, you will see exactly what I mean. What you need to remember for now is that this operating activity section begins with the income statement and makes some adjustments to it, or with net income, excuse me, and make some adjustments to it to get to how much cash was actually generated by operating activities. And if you look here, I just want to show you quickly. We were doing stuff with, let me just see if I can, if this, sorry, this is not what I was trying to open. All right. We were looking long ago at Amazon's financials, and I mean, just for the sake of seeing that this happens in, I guess, quote unquote, real life, there's, well, that's the audit opinion. Amazon is audited by Ernst & Young. Here's Amazon's cash flow. So it's very busy. I'm not even trying to go line by line or anything like that. The point is you can see, right, that they have operating activities. That's their first section, then the investing activities, and then the financing activities. And this is what I meant, right? They start with net income from the income statement, and then they make adjustments to reconcile that net income to show how much cash was actually provided by the operating activities. So you can see if we look at 2018, they made a net income of $10 billion. I'm sure many of us are partly responsible for that number. And then they make all these adjustments to actually show that in the end, although it looks like the operations provided, $10 billion of income, the reality is that it actually generated $30 billion of cash, right? So that's a massive difference. It's like a $20 billion difference between what they had as their profit and what is actually cash that they have on hand. And you can see here the biggest contributors to the I guess the 20 billion is the fact that and we'll see this later on, that depreciation is a non-cash expense, so it actually is adjusted for, and they also had some stock-based compensation, which we don't have to go into. I just want to show you that at the end, after they do all their calculations, in the end they have, you can see here, they have cash of $32 billion, and they also show some of the non-cash stuff that happened and other items that they want to show separately. So this cash of $32 billion, if you go to the balance sheet, just going to scroll here quickly. It's these two numbers together, but basically the cash number at the end of the cash flow is going to be the same as the amount of cash and cash equivalents on the balance sheet. All right. So when we work through a statement of cash flows, and we will do that, we actually have a built-in check, because once you finish the statement of cash flows, the number that you end up on as cash, right, for the end of the year should be the same cash number as the balance sheet. So I guess the last thing that I'll say about, oops, that's not what I was looking for. The last thing, I'm clicking everything except the right thing, that I'll say about Amazon here is if you follow this line, you can see how the cash from operating activities has increased. This is a positive sign for a company. You don't want it to go in the other direction because this is the cash that they generate just by being in business before they do anything else. This is the cash that they generate. If this number gets negative, then it means that the company is close to going out of business. Does anybody have questions on any of this before I move on to talk about investing activities?
So we're basically doing chapter 17 today.
Yeah, for the most part. It probably won't be finished by today. It's a very involved chapter, very busy. So let me just see if there's anybody else looking for me on the chat. No. Okay, so investing activities, you can see here, this is from when a company is buying and selling stuff, assets, so property, plant, equipment, and so on. They might be lending money to other people. So this is when you guys know what investment means when you decide to put money into something, right? Some assets, it could be stocks, bonds, property, plant, equipment. You could lend money to an individual. That's when you basically choose to invest in them. So they will, for all of these, there are cash inflows and outflows. If I sell property, plant, and equipment, I'm going to receive cash, right? Because I'm selling something. So that would be a cash inflow. If I buy property, plant, and equipment, right, I'm going to be paying cash. And so that's going to be a cash outflow. So when you're thinking about building the statement of cash flows, remember we're always looking at, is it in or out, right? Positive or negative. So those are investing activities. It's pretty self-explanatory. If you look at Amazon, we don't have to go too deep into this. You can see they bought property, plant, and equipment, so it's all negative numbers, right? Here's proceeds. This is when they sold, so this is going to be a positive. Sales of securities, positive. Purchases of securities, negative. So that begins to show you how to structure the thing. And then financing activities, as I said, is, you want to think about what we were doing in chapters 13, 14, and 15. The way a company finances its business is through issuing stock, through borrowing, maybe through a mortgage or a bond payable. They also pay dividends, and dividends form part of financing activities. So yeah, some of, what I was just saying, some of the examples of things that could go into financing activities. Okay, so the operating activity section is the most important part of the cash flow because of the fact that it shows how much cash is generated just by being in business, right? And if you were thinking about investing in a company, you would want to make sure that that operating activity section has an upward trend in terms of generating more and more cash over time. All right. And so what I wanted to show you here in the textbook, and we obviously we don't have to go through every single item, but there's a very helpful graphic in the book that goes for every type of activity. It discusses what might be the types of inflows and outflows, and so you would do well to read this a little bit and make sure that you understand why something is an inflow and why it is an outflow. The easiest way for me to in my mind to remember it is if you just think about what would be the journal entry. Like if I issue stock for cash, the journal entry is that cash goes up, right? So that would be a cash inflow in the statement of cash flow. So yeah, I recommend that you just spend some time looking at illustration 17.1 so that it can just help you to know how to classify different items in the cash flow, because for many students it's actually probably the most difficult part is to know where an item goes in which of the activities. And like I said, non-cash activities are also a factor. Sometimes we don't even receive cash for something. So issuing stock for land, classic example. There are other examples, converting a bond to common stock. There's also no cash involved. And again, here's this, consider the journal entry which would be involved. And you don't put a non-cash activity in the what we would call the body of the cash flow statement. And by the body, I mean everything that's happening up to the end of a year, right? You will put it at the bottom of the cash flow as additional information. Okay, so we'll do example one, which is just a very quick example, trying to figure out whether something falls into, or which category, excuse me, something falls into. So, like I said, some of you who already downloaded this document last week, I forgot and I put some of the answers in. But if you just download it today from Blackboard, it should be blank. What I want to do is ask you to maybe just take 2 or 3 minutes. I'm just going to step away from the computer here for a second. 2 or 3 minutes to just read through these different types of transactions. If you already have the answers there, it's fine. Try and make sense of why the answer is what it is. If you don't have the answer, then try and ask yourself, right, whether the transaction resulted in a cash flow from operating activities, investing activities, financing, or is it a non-cash investing and financing activities. So we're basically just trying to classify these transactions to begin. Hopefully you can begin to understand where they would go on a statement of cash flows. So let's say by 11:06, I'll talk it through with you, but for now, just read it through for yourself. I'm going to step away from the computer for like 2 minutes. I'll be right back.
So, Professor, for today, we're doing the class example 1 solution.
You're doing example one and you're just trying to, if you already have the solutions there, just read it through. Otherwise, try and figure out which activity it falls into. Okay?
Yeah.
All right.
So for today, we're not really doing the class example 4 to 7. We're just doing like class example 1 solutions.
We're going to work as far as we possibly can through all these
Okay.
examples. Sorry, I now understand. You're asking me what all we're doing today. We're
Yeah.
working right down the line as far as we get.
Okay.
Professor, where can I download this PDF? Because I re-downloaded it again today and it's still the old one.
The revised one, you mean?
Right.
Is that what you're talking about? Hello?
Yes. Can you hear me?
Yeah. So I put revised. So whatever you're downloading should say revised, and it should have no answers in it. But regardless, I mean, that's the only thing that I revised, so it's not a big deal. There's no other change to the document.
I go to course material and then chapter 7.
You go to due dates and due dates, sorry, Zoom call materials. I've been putting everything under Zoom call materials because that's really where we're focusing our attention on the Zoom call. So go to Zoom call materials and go to the Zoom call for 5, 6, and 511 and
I was going to course material. I gotta take
yeah,
it.
and I think that's fair. That's fair. That means I haven't updated it there. So thanks for the heads up. All right, so we're actually a minute over the amount of time that I gave you, but you guys still want a minute or two to go through it? I'm flexible. I just don't want you to be sitting twiddling your thumbs if you're done already. It's difficult to know, right, where people are at. So why don't you guys just keep going, and I will start. I'll start with A and work my way through, and those who are still going can just figure it out as they go along. Since some people have the answers anyway, I'll just go through the answers and explain why they are what they are, as opposed to trying to ask people to answer it, because it's kind of pointless and some of you have the answer in front of you. So Tavares Corporation had these transactions during 2014. A, they issued $50,000 par value common stock for cash, right? So so now the question is, where does this fall into, right? Operating, investing, or financing activities. So if you think about what this is, issuing stock is a way for a company to raise funds, right, for its business. So this is definitely going to fall under financing activities. And if you wanted to think through the journal entry, you would debit cash for 50,000 and you would credit common stock. Okay, it says that it's just a par value, so just credit common stock for 50,000. This debit to cash means that it is a cash inflow. I know the question didn't ask for this, but you know me, I'm always going to be a little bit extra. I'm telling you it's an inflow because in future, when you're actually building the statement of cash flows, you will have to know whether it's going to be a plus or a minus. And again, it's financing because by definition, the financing activities has to do with how the company raises money and pays back whatever money it's raising in order to finance its operations. Any questions on A? All right. So that's A. So for B, we purchased a machine for 30,000, giving a long-term note in exchange. So here you have to be careful because when you say purchase the machine, it sounds like investing activities, right? To purchase property, plant, and equipment. But how did we purchase the machine? Did we pay cash? Yes or no? Anybody? Did we pay cash for this machine?
No.
No, we did not. Thank you. So we would have said debit equipment or debit machine, and we would have credited the note payable, right? So there is, what is going on here? Sorry. So there's no cash involved. And again, you didn't have to write out these journal entries. I think there is one of your homeworks that kind of walks you through journal entries. So this might be helpful anyway. So what does this then mean? This is a non-cash activity, specifically because we know that the purchase of property, plant, and equipment is part of investing activities. It is a non-cash investing activity. Questions, anybody?
No.
All right. C, we issued $200,000 par value common stock upon conversion of bonds having a face value of 200,000. So again, if you think about the journal entry, you're debiting, sorry, I don't need to make that caps. You're debiting bond payable with 200,000 and you're crediting common stock with the same. Again, there is no cash involved. So this is going to be the same. It is a non-cash, but not investing. I'll change it now. It's a non-cash financing activity because remember, and I'll come back to the sheet in a second, financing activities involve sale of common stock, issuing debt, dividends, redeeming debt. So although it's non-cash, we still specify which type of activity it relates to. So non-cash financing activity for C. In D, you declared and paid a cash dividend. So where do dividends fall? Going back here again, remember, a cash outflow to stockholders as dividends, that's part of financing activities. So D will be financing. And it's going to be, I know you weren't asked first, but just in case you're confused, it's going to be a cash outflow, right? Because what's the journal entry? Debit dividends payable. Might ring a vague bell from chapter 14, and credit cash. So there is cash involved, which means that we do have to put this into the cash flow, and this is going to be cash going out, right? It's an outflow minus. So D is financing activities and it's cash going out. E, sold a long-term investment at the cost of 15,000 for 15,000 cash. So the fact that it's telling you that something was sold for cash, you already know it has to go into the cash flow statement. Let's see where investments fall. Yeah, from sale of investments, right? This is a cash inflow under investing activities. So we're going to put investing. And if you wanted to know how the journal entry went, you would debit cash, right, which is where the inflow is coming from, and you would credit investments for the same. So that's an investing activity. F, collected 16,000 of accounts receivable. So where on earth does that go? There's no mention of accounts receivable under financing or investing. It must then mean that it's got to do with the sale of goods and services. It's got to do with our day-to-day activities. So this is going to be operating activities. And remember, this is a cash flow because when you think about collecting cash for accounts receivable, you're debiting cash with 16,000 and you're crediting accounts receivable with the same. So cash is involved and it's a cash inflow. And then the last one, paid 18,000 on accounts payable. Same thinking, it's got to do with our day-to-day activities, right? To suppliers for inventory or whomever the accounts payable may relate to. So it's also an operating activity, right? And in this case, you're debiting accounts payable, right, with 18,000. And you're crediting cash with the same. So because cash is being credited, this is an outflow. Again, these extra things about whether it's an outflow or inflow and the journal entries, that's just me adding to the answer to facilitate your understanding. But this question simply asked for which operations this falls into. Anybody have anything they want to add or something that needs clarification? Okay, good. So this is I guess, the beginning of trying to understand how to classify transactions in order to appropriately prepare the statement of cash flows. What we'll do now is go into the steps
Please.
for.
I just
Sorry, is someone talking to me?
one more time, please. I need to take notes. Just a second.
Oh, yeah, sure. I can wait. Hang on, let me just let me send this thing up and position this nicely. Okay, you should be able to see that now.
Thank you. Thank you so much.
Okay. Anybody else who needs a moment? All right. Okay, so our next step is to figure out how to actually build a statement of cash flows. Um, I think the first thing that we need to note here is that we are using what's called the indirect method. There are two methods. Let me see if they talk about them here already or in the next section. I think it's in the next section. Yeah, so in this section where they talk about preparing the cash flow, they discuss the two different methods that companies may use. The indirect method, which starts with net income and then adjusts the net income for various items in order to get to net cash from operating activities. Or you can use the direct method, which is taking the information of receipts and payments directly. The companies definitely prefer this method. It's most widely used, and the reason is that the Financial Accounting Standards Board, even though they prefer the direct method, if a company uses the direct method, they still require the company to show the indirect method in the footnotes to the financial statement. So basically, if you do the direct method, you're ending up doing both methods anyway. So we will focus our attention on the indirect method, and it's called the indirect method because you don't look at cash receipts from customers and pay to suppliers directly. You start with a net income that has all the revenue, expenses, gains, and losses, and you work from that indirect point down to net cash from operating activities. All right. So that's, when you're reading the textbook, or if you have read it already and you're wondering why we are preferencing one method over the other, it's because this is the one that's generally used in practice. So how do we prepare the cash flow? We actually start by using the balance sheet and income statement. And if we're not given an entire balance sheet and entire income statement, we certainly would be given all the relevant information that we need from that balance sheet and income statement to be able to do our work. And here's an important point, right? The purpose of the cash flow statement is to show the sources and uses of cash, like where did cash come from, where did it go to? But the bigger issue is to explain the difference between the net income or loss in the income statement versus the cash that is actually flowing in and out of the company. Remember, we just saw with Amazon, right? They had a 10 billion net income, but it turns out that the cash that they have from operations is actually 30 billion. So then someone would want to know, like, how is it possible that you have all this extra cash on hand? Where did it come from? Are you expected to continue doing that? Plus, Amazon would want to show, right, because it's to their benefit, to show that even though we only have 10 billion in profit, we actually have 30 billion in cash, right? So they're cash rich, even though they never pay dividends and stuff, which is a whole other story. So the whole time as we build the cash flow, we're going to be thinking about going between accrual accounting, which is the income statement and balance sheet that says transactions are recorded as they happen, regardless of whether cash is actually received or paid, and the cash basis, which says we only record transactions that involve cash, and we also have to make adjustments for any non-cash activities to make sure that we are just focusing on cash. So then, and the book will tell you this as well, in order to really get going, we need comparative balance sheets, which means we need balance sheets for more than 1 year. And for the the 2 latest years, because we're looking at changes between account balances, and if we don't get given the whole balance sheet again, we would be given the information that we need. We also need the current income statement to see net income, and then there would be additional information that we will need in order to allow us to classify items correctly as either operating, investing, or financing, and also to calculate any gains and losses from sales, and so on. So, there's a lot going on. 3 major steps in preparing the cash flow. You first figure out what's happening with operating activities, right? That's by far the biggest and lengthiest part of the cash flow, and that's what we'll do first, so that we can make sure that we understand that. And then you look at all the changes in all your assets and liabilities for the purpose, and stockholders' equity for the purposes of completing investing and financing activities, or to account for any non-cash transactions. And then in the last piece, and this is what I was saying before, you look at the change in cash for the year, and then you will see that when you add the cash from the beginning of the year to that, you should arrive at the cash at the end of the year. Now, I'm saying this very much in the abstract, and I want to see if well, these have already been, I know that there's a kind of a mini cash flow at the end here. Yeah, okay. So in illustration 17.2 in the textbook, you can see, I mean, there's no numbers here, but it's basically showing you, right, how we split up the different activities. But then this is what I was talking about there at the end. Once you've added and subtracted all your different activities, it will tell you by how much cash has changed for the year. And to that, you add the cash at the beginning of the year to get to the cash at the end of the year. So this would be the same like if you looked at your bank statement. You see some balance that you started with, let's say at the beginning of the month, then you see all these activities that are pluses and minuses. If you had to add them all up, maybe they come to one particular amount. If you add or subtract that amount from the beginning balance, you should come out to the ending balance. So it's just a type of reconciliation to say, this is what we did with the money, this is what we started with, so this is what we end with, and this cash at the end of the period is the same as cash in the balance sheet. All right, so those are the 3 major steps that we do. So to start, and sorry that there's so much talking by me, but it's because it's the beginning of the chapter and there's so much to explain, but we will get to more examples here in a moment. So step 1 is the operating activities that I was talking about. We've already discussed that we're trying to start from net income, which is on an accrual basis, to get to net cash, which is on a cash basis. And in order to do that, we have to make some adjustments to net income. And what's nice about this is that it's actually, these things are stipulated, like this is what you have to do. You don't have to come up with ideas yourself about what the adjustments should be. They are actually just dictated to us. So you start with net income, you add or subtract the amounts of the adjustments, and that gets you to net cash provided by, if it's a positive number, or used by, if it's a negative number, operating activities. So what do we adjust net income for? You add back any non-cash expenses to net income, such as depreciation expense and amortization expense. So if you looked at an income statement, let me see if I can find one for us that is something to be that's fairly simple to follow. All right, so this is from illustration 17.4. So here's an income statement, right? You see we start with sales revenue, we do cost of goods sold, we've got all these operating expenses, and then we have depreciation, right? Expense of 9,000. There's a loss on disposal of plant assets, interest expense. All these expenses together come to 315,000. That 315,000 subtracted from 507 gives you income before income tax of 192,000, right? And then you apply your percentage of income tax, you get to 47,000 as the income tax expense and a net income of 145,000 in the end. This 145,000 net income number is what we will start the operating activities section on, right? 145. Now, in this number, there are going to be things that are treated as expenses, but they are not actually paid in cash. One of them is depreciation. When we think about depreciation, it's, you're just recognizing an expense for the use of an asset that you already paid for long ago. So you're debiting depreciation expense and crediting accumulated depreciation. Cash is not involved in that journal entry at all. So in order to get closer to how much cash the company actually generated, what we are required to do, and I'll show you here, they do it. What we're required to do is we start with net income, but then we actually add back the depreciation expense to show that this was never paid in cash. And so already our cash number is higher, right? Net cash is higher than net income. Questions there, or someone need me to repeat that, because it's a pretty important concept. All right. And just to point out, in the quote unquote real world, right? Here's Amazon's 10 billion of net income, and they're adding back their depreciation of 15 billion to work towards the net cash number. So this is something, that's definitely happening all across the board and has to happen because depreciation is non-cash. So that's the first thing that we do when we start making adjustments. You add depreciation expense. Then there are some other things that you have to adjust for as well. And this is a little bit tricky, but I'll try to explain it to you as clearly as possible. Let me go back to that income statement. In this income statement, you see that there's a loss over here, right? Loss on disposal of plant assets. That obviously just means that they sold some assets and they sold them at a loss, unfortunately, right? A loss of $3,000. And as a result, that $3,000 was subtracted, right, as an expense, basically, or as part of the expenses in the income statement. So the loss went into this number, which we include in operating activities. However, if you look at, just go back here, if you look at this previous graphic, right, anything to do with the sale of property, plant, and equipment should actually be part of investing activities, not part of operating activities. So we have a mismatch because the 145,000 of net income includes a deduction of $3,000 for a loss on a sale of an asset, but this number, anything to do with the sale, should really be part of investing activities. So what we need to do is remove the impact of this loss from the net income number, because we will show the entire transaction related to this sale under investing activities. So because this loss was a minus over here, what the instructions tell us is you add back that loss amount so that you can basically eliminate the entire impact of the loss. So I'll show you here in the, maybe for those who are a little bit more visual, you can see, I'll show you here in the book, the loss gets added back on and it makes the net cash number even higher, because we're saying we don't want this loss to be part of operating activities. It was already subtracted from here. We want to add it back so that the impact is zero, because we will deal with a loss later on when we deal with investing activities. It's a very tricky concept. So does anybody want to ask me any questions or need further explanation on that? All right, so I'll take the I'll take the silence as meaning that the questions will come when we're actually trying to do examples, right? So just like you added a loss back because you don't want it to be in the net income number, you want to deal with it in investing activities. If it had been a gain, you would just do the opposite. So a gain would usually have been added, right, to increase net income. So in order to remove the impact of the gain, you will subtract the gain from net income so that the net impact is zero, right? We added a gain in the income statement. Now when we come to the cash flow, we deduct that same gain so that we now have a net zero impact, because all of these things are going to be dealt with in investing or financing activities depending on the type of transaction. So that's the second type of adjustment that we make. We look for any gains and losses that would have been included in net income, and losses will be added back so that the impact can be zero. Gains will be deducted for the same reason, because they will then be dealt with lower on in the statement of cash flows in either investing or financing activities. And then the last piece relates to analyzing non-cash. So we're not analyzing cash. At any point in the cash flow statement, you're not looking at, oh, what changed in cash, except right at the end, right, where you see, oh, this is the change in cash based on these three types of activities. So you want to look at current assets and current liability accounts to see if there were changes in them, because that will also impact your operating activities. So why do we say that? Looking again, sorry, I'm in the wrong thing. Looking again at our income statement, you see here we have sales revenue of 507,000. Do you think that all of that revenue has already been collected in cash? What do you guys think? Yes or no? A revenue number that is in an income statement, does it mean that it's all been collected in cash or no?
Yes.
Okay, so I'm going to say, I'm going to ask you more questions. Is it possible that people could have bought stuff on account?
Yes.
Yes. So the answer is actually going to be that we have to look to see what happened with accounts receivable to determine whether all of the stuff was collected in cash or not, right? And so unfortunately, we start with a net income of 145,000, but we have no guarantee of whether this is the exact amount, whether sales revenue is the exact amount of cash that was paid, and whether this total expense is the exact amount of cash. Sorry, did I say paid? I meant received, excuse me. And whether this expense was the exact amount of cash that was paid. We just don't know unless we look at what happened with accounts payable and accounts receivable, right? For the receivable, we're seeing whether our customers actually gave us cash, whether we collected cash more than maybe what we are showing on the income statement. And for the payable, we're trying to see whether we actually paid money out for all of these expenses and inventory and things, or whether we actually ended up holding back some money and we're only going to pay for it in the future. Same for any other payable, like income taxes payable. You can see here the balance dropped, which means over the year we must have paid some of our liability for income tax as well. So, pardon me, this part of the analysis is to figure out whether whether the number that we are showing for net income is accurate or whether there were actually cash inflows and outflows because of changes in current assets and current liabilities that we are not accounting for in the income statement. Because remember, if accounts receivable goes down, you're saying debit cash, credit accounts receivable, so that information never makes its way into the income statement. So what's the short answer here for the people whose eyes have already glazed over? Is that basically in the third step, you have to look at the changes in your current assets and current liabilities to see if there have been any changes, and then you will have to adjust for those because the net income number does not take those changes into consideration because these are all balance sheet accounts, and the changes in those accounts are not going to necessarily be reflected in the income statement all the time. So here's actually rules of thumb or a cheat sheet, right, to say how do you account for these changes. If there's an increase in current assets, you deduct and so on. This is going to be meaningless for now until we actually do an example and you'll be able to see it in action. So now if you had to attack an operating activity section of a cash flow and try and figure out how to do it. Your first step is to say how much is net income. That's where you start, right? You put in your net income number and then you tell yourself there are three types of adjustments that I need to make. Right, and these are the three types of adjustments. And if you just work systematically through those three types of adjustments, you can hopefully successfully complete the operating activity section, which again, I'm just saying this for people who may be losing heart. This is by far the most difficult part of the cash flow. So if you can master this, the others actually flow much, much, much faster because you don't need to make these types of adjustments all over the show. Questions here before we tackle an operating activity section in example 2? Anybody need me to repeat something? Okay, so let's turn our attention to example 2, which is Scoggins. I'll read it with you. I'll go over all the movements with you, and then I'll also build it for us. Just let me, there's my, just open something here. This is very small. Maybe I do better in Google Docs. Okay, so let's read through this and see if we can figure it out, okay? The instructions are telling us to prepare the net cash provided by operating activities section of the company statement of cash flows for the year ended December 31st, 2014, using the indirect method. So first of all, they're only asking for operating activities. They're asking us to use the indirect method. We kind of have an idea of what goes in there, right? Because it's net income, plus or minus the three types of adjustments. So going back to the top here, the current sections of Scoggins Inc.'s balance sheet at December 31, 2013 and 2014, notice what we were saying before, right? That it has to be comparative balance sheets, which means you have to have information for at least 2 years worth of balance sheets because you're looking at changes in some of those numbers. They're presented here. Scoggins has net income of 153,000. So they chose not to give us a full income statement, but they do give us the net income number. They also tell us what the depreciation expense amount is, which helps us because we know that the first adjustment that we need to make is to add depreciation back onto net income because it's a non-cash expense. What you can also see here is that they tell you what the cash balance is. We are not doing an entire cash flow statement, but if we did, we would know that the cash flow statement has to end on 105,000 because that's your starting cash for the year was 99,000. You end on 105, so you can see that it looks like there's a $6,000 increase, right, in the amount of cash that you have, but that could be from all kinds of increases and decreases in other in the various areas, the various activities. So what do we need? Because it's specifically operating activities, we need to look at all the different current assets and current liabilities. We need a depreciation number. We need to see if there are any gains or losses. So we see here that we have accounts receivable, inventory, and prepaid expenses. Those are all classified as current assets. So if you have some issue with understanding the classification, remember that a current asset is an asset that we expect to receive the future benefits or consume, use up in some way within 1 year from the balance sheet date. And these things are pretty much defined. Cash is a current asset, but we don't concern ourselves with cash because we're actually trying to explain the change in cash. But certainly accounts receivable, inventory, and prepaid expenses are current assets. Prepaid expenses sounds like an expense, but remember this represents the situation where you are paying in advance, right, for expenses that will happen over time. So the classic example is prepaid insurance. If I pay insurance today that covers the next year, I actually have an asset because I'm paying today and I'm going to receive a future benefit of insurance coverage moving forward. So prepaid is definitely an asset. Inventory is, of course, a current asset. Inventory is also a current asset. For current liabilities, we have accounts payable. You already know what that is. That's when you buy stuff on account and you have to pay it off within 30 days or 45 days. Accrued expenses payable, right? The word payable is there, so it should give you a hint that it's also liability. What is this? Accrued expenses is, at the end of the financial period, when you have some expenses, like let's say a Con Edison bill that you haven't paid yet, but the expense belongs to this time period, you have to record a liability for it, okay? So it could be various things, utility bills, other types of expenses that are included in this. It is also a current liability. So, like I said, often the biggest issue with the cash flow is making sure that you know which items have to go where. So if you are still thinking about, well, what's a current asset, what's a current liability, remember you can also go back in the chapter to it's chapter 4, or not back in the chapter, back in the book. In chapter 4, we have what we know as the classified balance sheet. I'm not going to go through all of this now. We don't have time for it, but I just want to show you that, oh, I got kicked out of Wiley, sorry. I'll come back, but in any case, you can see
It's working. It's not working for me.
Oh, maybe it's not working in general then. Okay, thank you. The classified balance sheet would be able to show you what is a current asset and current liability. I'll try again later. Maybe it will let me back in. So let us stop the talking now and try and see if we can actually do this. So with any financial statement, it's the normal stuff. You write the name. I'm doing example 2 again, just in case you were away from your desk. You write the name of the company, right? So Scoggins Inc., the name of the statement, statement of cash flows. Sorry, my typing is still catching up today. So a cash flow statement, obviously based on just the structure of what we're trying to do, it's going to be for a period of time. It's not at a point in time because we're explaining all the cash flows in and out over the year. So it's going to be for the year ended December 31, 2014. And yeah, I just have to mention again that if we were in our normal class, I would give you a template for the cash flow, not in the sense that every single name of every item would be filled out, but certainly these major headings like the different activities, also some of the longer things. That's again not an issue with me wanting you to memorize, things that you can find easily, because if you were working in practice, you wouldn't have to memorize that. So when you're doing the homeworks and stuff, you can sit with, a sample cash flow in front of you so that you know how the flow goes, okay? So this is a heading, cash flows from operating activities. That's to show the reader, right, that we are starting, some part of the cash flow. Remember the steps now from our theory over here. Start with net income and make the adjustments. So that's exactly what I'm doing. They told me that net income is 153,000, so I'll believe them. And I'm putting net income, leave some space here because I'll probably have to do some subtotals for the other items. So net income is 153,000. Pardon. Questions up to there, anybody? Okay. So now you let the user know that you're about to make adjustments to net income. I don't expect you to, I should know what this says, but you don't have to memorize this. So this is adjustments to reconcile the net income that we started with to net cash, right, provided by operating activities. So we're telling someone who is looking at the financials that we're about to tell you how to get from this accrual, and you don't have to write this on your normally on your cash flow, but we're trying to get from this accrual number, right, accrual basis of accounting to a cash basis, and this is how we're going to do it. So our first step based on our theory is to add back depreciation, right? There's the 24,000. Remember we said add back non-cash items. So you can even leave a space if you want to, just so everything's not on top of each other. Depreciation expense is the first item, right? I think I need an extra column here. You organize yourselves however you want to. I'm not doing a good job of organizing myself properly. So depreciation expense, 24,000. This is going to be a positive, so you just leave it like that, right? Because you're adding it back. That's adjustment number one from our list of adjustments. What do we adjust for adjustment number two? What are we looking for in adjustment number two?
Current assets?
Now, one step above that, there's something else. Anybody? What's the number two adjustment? Should I go back up to remind you?
Add losses and
Yeah, deduct gains and add losses for anything that resulted from investing and financing activities. Do we have any gains or losses in this question that we need to add or subtract? I just closed the thing. Sorry, 1 second. Do we have any gains or losses that we need to add or subtract? Sorry, I'm just trying to get back to my notes. Okay. If you look at, I'll put you out of your misery, okay? If you look at this question, there's nothing being said about gains and losses. There's nothing about anything being sold. So you're good. And under normal circumstances, if you don't have any gains or losses, you don't have to put the line in. I'm just putting the line in because I want you to remember that that's something you need to look for, okay? Since we're still learning these adjustments. And then the third adjustment is looking at the current assets and current liabilities and looking for increases and decreases in those items to see whether they need to be added to or subtracted from net income. And guys, I know this is, this is why I gave out all those warnings on Wednesday. Statement of cash flow is very odd. It's like, what are we doing, and how am I supposed to remember all this stuff? I will say that, one, you definitely need to pay attention and follow what I'm doing. But two, by the time we're done with this chapter, most, if not everybody, will be able to do a statement of cash flows, because what you really just need is repetition, okay? Because you'll start to see that it's the same thing over and over again. So don't panic now. This is only the first go around, so it's okay if you don't know what's going on. I'll keep explaining. So the first thing that we're looking at is accounts receivable. If you look from 2013 to 2014, accounts receivable has gone up, right? It's increased by 21,000. What this then means is that we have some customers who have not given us the cash, right? They've not paid us the money, and so there's sales revenue in here that wasn't actually collected in cash. If you don't want to think it through so deeply, you can go back to the list of adjustments, and you see there, if there's an increase in a current asset, you have to deduct the amount, you subtract the amount. So an increase in accounts receivable, which is a current asset, at 21,000, that increase has to be a subtraction. And as I type it out, I'll say again why that is. Remember, let me just 1 second. Let me just fix this number so that there's a bracket around it. All right, so I'll repeat, right? Our accounts receivable balance went up by 21,000, which means there's $21,000 worth of sales revenue that we made and included in the income statement that wasn't actually collected in cash. So that amount needs to come out, because remember, we're trying to get to a cash number, and unfortunately the income statement includes sales that weren't actually received in cash, and we can tell that because the accounts receivable balance went up. Stop me at any time if you have questions, okay? Or if I need to repeat something, this is heady stuff, and I'll give a break here. Maybe after we do inventory, I think we can take a break and just let some of the stuff settle in our brains. Inventory is also a current asset. Inventory represents, all the items of stock that the company has on hand that it has not yet sold at the end of the year, but is intending to sell at least within 1 year, right, from the balance sheet date. And inventory is connected to cost of goods sold, because once you actually sell the stuff, it changes from being inventory and becomes the expense cost of goods sold. So what happened is our inventory went down by 14,000, which means that we actually sold some inventory that was in stock that we did not pay for in cash. Okay, we had already paid for it in a previous year. This part is also tricky. So this $153,000 of net income includes cost of goods sold, right? That has inventory in it of $14,000 that wasn't paid for in this year. So what we need to do is, and if you really don't want to think that through, it's okay, I get it. The other way to do it is very easy. You just say, oh, there was a decrease in a current asset, so I'm just going to add the amount in. So inventory is a current asset. There's a decrease in, in inventory, so the 14,000 represents an addition to net income. So what did we learn there? You could think this through in the logical way of why this addition makes sense. But if you really can't keep up with why it makes sense, you can also just memorize what to do to the amount and you'll still get the right answer. Okay, so I'm going to stop there and give us a 10-minute break until 12:05 so that, you know, everybody's brain doesn't seize with all this explanation. And then when we come back, we'll finish up this operating activities. If someone has questions for me during the break, I'm happy to answer them. I'll just pause the. All right, we're back. I was just finishing the attendance. So going back to this question, we were on the decrease in inventory, and we're still looking to see the changes in the current assets and current liabilities to finish up the operating activities section of the balance sheet. So we have not yet tackled prepaid expenses, the accrued expenses payable, and accounts payable. So looking at prepaid expenses, that went up by 5,000, right? So the way prepaid expenses work is you're obviously paying for an expense in advance of incurring the expense. So cash is leaving your pocket, but the expense doesn't show up in the income statement until, you know, the time comes that the expense is incurred. So that means that this $153,000 of net income does not include any impact of prepaid expenses, yet cash was paid, right? Because you said, for instance, debit prepaid insurance, credit cash. So that cash payment isn't included in here. And it's an increase in a current asset. So if you just want to go this way, increase in current asset, you have to deduct. So we go here and we say increase in prepaid expenses, and it's 5,000 was the increase, and you're going to subtract the 5,000. Okay, and next is the accrued expenses. I'll just go through it all, and then maybe at the end, if people have come up with questions, you can ask me. Accrued expenses payable has increased by $10,000. What this means is that we have expenses that have been recorded in the income statement, but they were not actually paid in cash because the credit didn't go to cash, it went to a liability. So the fact that this liability increased means that we kept cash in our pocket, right? But that was not accounted for in the income statement because all those expenses were actually subtracted in the income statement. So an increase in this current liability is going to be added back. And if you don't want to think through the logic, you can see it over here. When the current liabilities increase, we add that amount onto our net income. So we are saying increase in accrued expenses payable. That was $10,000 and we add it on. So again, I'll say, you know, for those, I know there are some people who actually want to follow the logical explanation for why we're adding and subtracting. I'll always keep giving that. But if you feel like, wow, this is so overwhelming, I can't remember all the reasons why we're adding and subtracting, I'm going to ask you, why do we add this or why do we add that? You can also just memorize these 4 things and it will help you every time when you are analyzing current assets and current liabilities. You will know whether you should add or subtract, okay? And then the last one is accounts payable. Accounts payable went down by 7,000. If you think about that journal entry, it's going to be debit, accounts payable, credit, cash. So cash flowed out of the company, but that cash outflow was not accounted for in net income because it doesn't involve any revenue or expenses, gains or losses. So we have a 7,000 that was paid, but that payment isn't in this number. So what we have to do is account for a decrease in a current liability, and you can see that we have to deduct. So decrease in accounts payable, we subtract the $7,000 dollars over there. So now if we think back to our adjustments, we said start with net income, adjust to add back any non-cash expenses like depreciation or amortization. You deduct any gains and add any losses, but we didn't have any. And then you analyze all your non-cash current assets and current liabilities for increases or decreases in those amounts. And then you add or subtract them based on the logical explanation. But failing that, if you don't understand the logical explanation yet, then you can just add and subtract based on the rules that we are given in the textbook. So then at this point, what we have to do is add and subtract all these numbers from each other to get to basically a total of all the adjustments. And that total we either add to or subtract from this net income number. So if I just do this, I can see that the total is 15,000. So I'm just going to write it in over here. It's 15,000 positive because the positive numbers are bigger than the negative numbers. And then that 15,000 gets added to the 153 to bring us to 168. So these three numbers are connected to each other, right? The 15,000 is the final total. This is the total of all the adjustments. And the 168 is the cash basis, right? This was the, excuse me, the accrual basis. And what is this number called? This is net cash provided by operating activities. Okay, so now you can wipe the sweat off your brow and ask me any questions if you have anything.
Can you go up so we can see the full picture?
You mean like that? With the name of the company or like that?
Yes, thank you.
Other questions? So everybody knows exactly what's going on, is what you're telling me. Okay. Let's look at, since no one's asking anything, which again, I know doesn't mean that you totally understand, but rather that you're probably still trying to process all this information. Let's do a simple example, a very simple example for you guys to do on your own to try and figure out the operating activities section. And then after that, I'll do a whole cash flow with you. I'm just trying to see which example would be, yeah, this is a good one. If you turn to number 7 on the handout, this Gutierrez, this is actually used to be in the book. I'm sure it's all the same one. Everybody sees that, right? Gutierrez Company. So what I want you guys to do is using, and I'll put my example back up, but using the example that we just went through, I'd like you to spend some time preparing the operating activities section of the statement of cash flows for this company using the indirect method. So basically the same thing that we did before. I'll read it with you. Gutierrez Company reported net income of $225,000. There's your net income number, right, for 2014. Gutierrez also reported depreciation expense of $45,000. So we know that that's part of the adjustments, and the loss of $5,000 on disposal of equipment. So there's another adjustment number 2. And then the comparative balance sheet shows a decrease in accounts receivable of 15,000 for the year, a 17,000 increase in accounts payable, and a 4,000 decrease in prepaid expenses. Now, under normal circumstances, when you're doing a cash flow, the information is not going to necessarily just be presented like this in a narrative. It's normally, you normally have a balance sheet and income statement and things of that nature. But this is just a quick example because I'm trying to test to see if you know how to adjust, right? How to add or subtract to net income to get to the appropriate net cash number. So that's the question. Hopefully everybody has the question, because I think it would be most helpful if I show this right on the screen. I'll give you, we'll start with 10 minutes to try and work through this this question, and then we'll see where people are at, and we can start going through the solution. Okay, so example 7, you can do on your own, and I'm right here if you have questions. Oh, sorry to disrupt your work, but I just got the service alert from Wiley that they have an outage. There's a technical issue. We are working to resolve this issue as soon as possible. All right, so they know that it's happening, and I guess they'll try and figure it out. Given to you in Wiley. So, but I'll just put it here, name of the company, statement of cash flows for, let's just assume it's for the year ended December. This wasn't given in the question, but I'll assume it's December 31, 2014. And so we have the same setup, right? Cash flows from all the stuff should be the same. Cash flows from operating activities. Net income was given as 225,000. For your adjustments to reconcile the net income to net cash provided by operating activities, what number do you guys start with? What's the first thing you're going to do? After net income, what are you going to do?
Depreciation expense.
Yep, depreciation expense. So depreciation expense was at 45,000. That's added back, so it's a positive number. What's next?
Disposal.
Mm-hmm. Loss on disposal, thank you, of equipment. So now the loss is weird, right? Because a loss is normally a negative, but because we are trying to eliminate the impact of the loss so that we can show everything later on in investing activities, we add the loss back, okay? And that's following exactly what the instructions tell us to do. Any questions up to here? All right. Next, we look for the comparative balance sheet shows a decrease in, oops, why am I not typing? Decrease in accounts receivable. Who wants to tell me, do we add or subtract that? Add or subtract a decrease in accounts receivable?
Add.
Add, thank you. 15,000 add. And that's like, you can think of a decrease in accounts receivable means you collected cash from people, there's more cash in your pocket, but it doesn't get shown in the income statement, so you got to add it in. And increase, oh, let's do the prepaid expenses first to just keep all the current assets together. A decrease in prepaid expenses, what do you guys say?
4,000.
Huh?
Negative.
Add. Am I doing the right thing? For the people who ever spoke, I couldn't hear what you said properly. Are you happy with what I'm doing so far? You've disappeared. Okay. Increase in accounts payable. What do we say? Add or subtract?
Subtract.
I'm going to challenge that. If my accounts payable balance goes up, does it mean I have more or less money in my pocket? Did I keep the money or did I pay it out? Do you see there?
Add.
You got to add it because I think I know why you said subtract. You can tell me if I'm putting words in your mouth, but I feel like an increase in a liability feels like a bad thing, right? It's like, oh no, our liabilities went up. Surely that should be a negative. But remember, you're thinking about the impact on cash, not necessarily the impact on the liability itself. If your liabilities go up, like if you choose not to pay your credit card bill at the end of the month, I mean, it might not be the best choice, but the point is that means you have extra cash at your disposal. So what's happening here is net income is taking into consideration anything that is an expense regardless of whether it was paid in cash. But when we see that our accounts payable balance went up, it means that some of the expenses that are subtracted here in the income statement actually weren't paid in cash. So we got to add that cash back because we have to show, that the cash actually was never paid out. So this is like a weird result because I'm sure you were worried because it's like everything is positive. That seems weird, but you're following the rules, and so the rules are dictating in the end that all of this stuff is actually a plus. Is that okay? Is there anybody who wants to query one of the? Go ahead.
I'm confused on second step. The loss on disposal.
Yeah.
Why is increased?
Yeah, so a good question. Now I can't go back into Wiley, but if you think about an income statement, right? I'm just gonna make up an income statement here. You've got sales, right? Then you've got, let's just say you say less all your operating. I'm not even gonna worry with cost of goods sold. Less all your operating expenses, right? You're also gonna subtract a loss on disposal. Do you agree that the loss would be subtracted?
Yes.
Okay. And then in the end, again, I'm just making up stuff here. In the end, you get to net income. So the net income number that you come to in this instance is 225,000. Somewhere along the line you said minus 5,000 to get to 225, right? You subtracted the loss in your income statement.
Yes.
So this number is lower by 5,000 because we subtracted the loss in the income statement. This loss on disposal of equipment is actually related to investing activities. Do you agree? Investing activities involve purchase and sale of equipment. Yes or no?
Yes.
You still with me? Okay. What's going to happen later on, we haven't done it yet, but we will create a section called cash flows from investing activities. And in this section, we will deal with the sale of the equipment completely. Then, you know, the wholesale, the cash, losses, whatever, we deal with it over here. So because we have to deal with the loss and the sale in investing activities, we need to remove the impact of this loss from operating activities. Otherwise, we are going to double count it. So when I have a minus over here, and then I put a plus, in the end, I am eliminating the impact of the loss so that anything to do with the sale of the equipment, I can include the entire impact under investing activities. What do you think?
Yes.
Don't you say yes? Does it make a little bit more sense why we're taking it out? Or can I repeat? I'm happy to repeat.
Uh,
Yeah, that sounds like a repeat. Where did I lose you? You're okay that the loss gets deducted in the income statement, right?
yeah, I understand that stuff. Yeah.
Yeah. So did I lose you over here about why we have to add it here?
Yeah. Yes. Actually, yes.
Okay. So let's just say I'm just gonna make up numbers here. Let's just put 330,000. I'm just making it right, and minus 100,000. Let's see. Is my math even correct here? I should come out to 225. Yeah. Okay. So if these were the actual numbers, sales was 330, operating expenses was 100, the loss was 5,000. In the end, right, we come to 225,000. You with me?
Yes.
If this loss, and I'm actually just going to do this so that this is an actual calculation, right? If this loss had not been there, we would have had net income of 230,000. Do you agree?
Yes, I agree.
But because the loss is there, our net income is only 225,000.
Okay.
Yeah, that the loss doesn't belong to operating activities, it belongs in investing activities. So we got to do that.
All right.
And that's how we do it, because these two numbers together are 230,000.
Okay, thank you, Professor. No, I understand.
Okay. Okay, great stuff. Any other questions? Okay, so let's see. How much does this all add up to? Somebody, what did you get? Did you get 86,000? Anybody?
Yes.
Yes, all right. So 86,000 positive, and so then remember you add now to the 225, and then you get 311. So these three numbers belong to each other in some way or another, and this is called net cash provided by operating activities. My typing is off today. So you should have come out to about 311,000. The floor is open for questions about any part of this section. All right. Now we're down to about 10 or so minutes. Let's see what would make the most sense to do with you. I won't be able to finish an entire cash flow. That's what's bothering me now. Would you guys like to practice more operating activity stuff? No answer. All right. Let me tell you one thing, and then we'll see in the time we have left what more we can do. I just want to mention this because I feel like I'm gonna forget it. At some point in the past, I worked through an example of one of the homework questions, exercise 17-8, which is a cash flow question. So I worked through the question. It's in two parts. It's on YouTube on my channel, but if you want to see it, you can copy and paste these links and you'll be able to see me go through it. It's one of our homework questions as well, and so I think that it would be useful for you to actually look at that, because it's going to help you to understand that question a little bit more. What I'll say is, because we're not going to finish an entire cash flow today, I'll probably, and because of all this nonsense with Wiley, I don't know about when they haven't notified us yet that they will, that they're back. So I'll extend the deadline by 1 day for the homework. I'll extend it to Thursday so that people will be able to finish on time. Let me start example 3, and sorry. And then when we join together on Wednesday, I'll work it through right to the end. But I think that example 3 is probably the most logical place to go now, because it's going to be the full cash flow. So in example 3, and I'm aware that we only have about 7 minutes, but I'll at least set it up. So it's asking us to prepare a statement of cash flows for 2014 using the indirect method. So it's the same idea. It's obviously December 31st. You can see the Rojas Corporation's comparative balance sheet. So balance sheet for 2 years. Make sure you watch the years to see which one is the most recent year and which year is the prior year, so that you're looking at the changes in the appropriate direction. So all the information is presented below. We'll go through it here in a minute. And then they also have additional information that tells us that net income is $22,630. And they have dividends were declared and paid 19,500. So this is you know, a new information now. We will need this for the financing activity section of the cash flow. All other changes in non-current account balances had a direct effect on cash flows. What they're trying to tell you here is that, I'll just write it in here, there are no non-cash activities. All right, that's why they're saying everything else had a direct effect on cash flows, except the change in accumulated depreciation. But we know that already, because depreciation expense is added back, right, as a non-cash expense. So the change in accumulated depreciation should not have a cash effect anyway. And then they're telling us that land was sold for $4,900. So we would have to look at the land balance to see, you know, if there's a gain or a loss on the sale. And let's actually just look at that now. So the land balance changed from 26,000 to 20,000. So what was the cost of the land that was sold? Anybody want to guess what is, if the balance dropped from 26,000 to 20,000, what was the cost of the land? This is not a trick question.
6,000.
Yes, 6,000. Cost of the land sold was 6,000. So something that cost you 6,000 is only sold for 4,900. Are you making a gain or a loss?
Gain.
Really? If something costs you 6,000 and you only sell it
Lost.
for 4,900,
I lost.
cost, right? Yeah. So there's going to be a loss, and the loss is going to be the 4,900 minus the 6,000, which equals 1,100. And we already know from the previous example that when there's a loss, we have to add it back in the operating activities section. So I repeat, right? They told us that land was sold for 4,900. So that's the cash that we received. But we still need to know how much did this thing actually cost us, or what's the book value, as we would call it, right? Book value. The reason I just spoke about cost with land is that land isn't depreciated. So cost and book value are the same. So we saw that land changed from 26,000 to 20,000. So that's a 6,000 sale cost of, or 6,000 cost of land that was sold, let's put it that way, and sold for only 4,900. So we made a loss of 1,100, goes into operating activities. So we've understood all of the additional information, and we could go back up and start trying to see how to build this. And so, you know, it all starts the same, and I'm probably only going to have time to do this. You're going to do all of these headings, right? The name of the company, so it's Rojas Corporation. You're going to do, you know, the name of the statement, and again, this is probably given in Wiley. It's for the year ended December 31, 2014, and then you start with the headings, right? Cash flows from operating activities. That's a heading. And so now you can put in your net income. So going back to the question, we know that net income was $22,630. So I want you to see here that there's a rhythm to it. The questions are all starting at the same place. So even if you are still a little bit iffy on, you know, cash flows, and I'm not sure exactly why we have to do this, how we do it, and so on, you should already be recognizing the pattern. And then, you know, you're going to put in this whole long thing, right? Adjustments. If you're writing this out, you can just write adjustments, because remember, I told you that when you do the test or when you do the homework, you can just sit with an example of the cash flow. And sometimes Wiley even just writes out that adjustments thing itself. So you don't even have to remember the whole long thing. The next thing that you do is depreciation expense. And in this question, and this is where I leave it, because I'll show you how to do this next time. They did not give us a depreciation number, right? They didn't give us an income statement. They didn't give us a depreciation number. But what we know is accumulated depreciation and depreciation expense are connected. So it looks like there was $5,000 worth of depreciation expense for the year. And we'll see next time when we come together if that is in fact the case. So I'm leaving it here. Next time we'll pick it up. I want to also just show you, besides that video that I told you about, I also just want to show you that all the solutions for all the questions in the back of this handout are already up, and they've been up on Blackboard under the Solutions tab. You have the solution for question 1, and then for 2 and 3 are separate in Excel spreadsheets, and 4 through 7 is in a Word document, because these questions were actually coming straight out of the textbook. So feel free to continue reading or practicing. I will extend the homework due date on Wiley, once I can get into Wiley, by a day, so that you guys are not penalized for the fact that you are trying to do work and we can't get in. I'll try once more now. I hate to keep you here for this, but let me just see if there's hope, so people know before we go. And while I'm logging in, someone asked me if I'm teaching in the fall. Unfortunately, not, because I'm pregnant and expecting a baby at the beginning of September, so I'm not teaching in fall 1. I am going to teach in the winter, fall 2, but I'm still teaching accounting 2. Normally in the fall I would have taught intermediate 2, but I'll be on maternity leave. Sorry guys, it's Wiley's still out. Okay, so I may even extend the homework to Friday. It really doesn't matter to me. Do people care? Do you want it to be extended to Thursday, Friday? Is it, you're neutral?
Friday.
Okay. Well, one person said Friday, so we'll call it Friday. Okay. Okay, so I'm going to stop the recording.